Peter Lynch summarized insider purchases perfectly. He stated, "Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise." So in this video, we're going to be looking at 3 dividend stocks that just recently had insider purchases. And coming in at number 1, we have Louis Vuitton, and we have been seeing a massive amount of insider purchases, not only in the last year, but especially in the last couple of months. Look at the frequency of these insider purchases. It's almost like it's been every single day. And if we scroll down, we can see founder Bernard Arnault has been the one executing nearly all of these insider purchases, and he's doing it almost every other day. Now, obviously, this is interesting for a multitude of reasons, but one of the things we do have to point out is if we look at the shareholder structure for Louis Vuitton as of the end of 2023, the Arnault family group, Bernard Arnault, owned about 48.6% of the outstanding Louis Vuitton shares. So it's clear, I think he wants to own over 50%. One of the things we also have to keep in mind when it comes to him buying back his own company's stock is that founder-led companies have proven that over time they outperform the market, and really by a pretty significant amount. Now, if we look at Louis Vuitton over the past year, they're down about 28% and pretty close to their 52-week low. Now, one of the things interesting about Bernard Arnault's insider purchases is if we look at Louis Vuitton year to date, we can actually see they were trading around where they are right now to start out the year. But we can see in late January, the share price shot all the way up to almost $800 per share. And ironically enough, Bernard Arnault was not buying shares when the share price was climbing. It was when it started to go down again. So on the way down, this sell-off we've seen year to date, this is when he's been buying his shares. Now, if we go ahead and jump over to my dividend breakdown sheet, let's come up here and plug in Louis Vuitton. And what we can see is that starting dividend yield is around 2.16%, but the company actually has a pretty decent history of growing those dividends over time. Now, we have to keep in mind, this is a stock based out of Europe, and typically European dividend policy is going to look a little bit different than that of stocks in the US. For example, if we scroll down, we can see they actually pay out their dividends on a semi-annual basis, and typically we'll see a large dividend payment at the beginning of the year followed by a smaller dividend payment. We also need to be aware of any tax consequences based on where we live. Now, here's what we do like about the stock. Look at the free cash flow growth over the past 5 and 10 years, both of them in the double-digit range, and 2021 was a record free cash flow year at about $15.4 billion. Now, it declined in 2022 and 2023, but as of 2024, we saw it start to climb up again at about $13.3 billion, while dividends paid out was about $7.3 billion, giving them a free cash flow payout ratio of around 54.75%. Now, if we go ahead and jump over to our profitability sheet, here's one of the things I do want to point out. For the industry this company is operating in, they have very high gross profit ratios. Look at this, the 10-year average gross profit ratio for this company is about 66.37%, and last year it came in at 67.03%. So it's been high, and it's remaining very stable, and it's remaining high. This is a sign of a competitive advantage. They sell luxury goods, and as a result, they get luxury margins. And when you combine the fact they have luxury margins with a 10-year revenue CAGR of close to 11%, I think you're going to like the end results. And if we jump back over to Seeking Alpha and look at the stock over the past decade, it's up about 258%. So what about the valuation? Is now an interesting time to consider buying at $637 a share? Well, to start out, Bernard Arnault obviously thinks it is a good time, as he's made 32 purchases in the last 90 days. But let's reaffirm this by looking at a few valuation metrics, and the first one we'll look at is going to be our reverse discounted cash flow analysis. And again, like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, what we're doing with a reverse discounted cash flow analysis is seeing how much free cash flow growth is currently priced into this stock. So for example, with 0% free cash flow growth rate projected into the next decade, we could see we'd come to an intrinsic value of just $303 per share, but the stock is trading at $637. So obviously the market is pricing in free cash flow growth. But how much? Well, if we bump this up to 5%, we'd come to a reverse DCF price of about $456. So we're pricing in more than 5. If we bump it up to 10, we actually get above the current share price. And if we bump it down to about 9.5%, maybe just a little bit lower, 9.4%, we get very close to that current share price. And it looks like if we go 9.3%, that's how much free cash flow growth the market has priced into this stock over the next decade. Now, like always, the question we have to ask is, if free cash flow is higher than this, then the stock's undervalued. But if it's going to be lower than this, then the stock is overvalued. And one of the things we do have to point out is it looks like free cash flow is recovering back to where it was in 2021. So perhaps over the short term, we could see higher free cash flow growth rates. That's possible, but if we look at the recent earnings report, one of the things I do want to point out is the company is really struggling in Asia right now. Look at this. Revenue in Asia in 2024 was down by 11%. That's a significant decline. And keep in mind, Asia is actually where the majority of their revenue mix comes from. We can see Asia makes up for about 28% of their revenue, but in 2023, it was 31%. So this number is actually declining due to the decline in revenue from this area. So I certainly think Louis Vuitton is a very interesting stock at today's prices. This is one I'm watching closely. The second dividend stock with insider purchases is actually a real estate investment trust I don't believe I've ever talked about on the channel before, but that is Armada Hoffler Properties, and we can see there's been a few insider purchases since the beginning of the year, but it's really ramped up just in the last few days when we saw the share price decline. Now, why did we see such a share price decline over the last few days? Well, this REIT recently announced they're going to be reducing their dividend by around 32%. So that's a pretty significant dividend reduction. But despite this, we can see the REIT still has a starting dividend yield sitting at about 7.42%. So it's still a pretty big dividend payer. Now, over the last year, this REIT is down about 24.65%. Now, typically, whenever we talk about a dividend reduction, it's not a good sign. And obviously, if you're currently a shareholder of the stock, it's not something you're excited about. But this can still be the right move for companies in certain scenarios when they need to free up capital. Let's take a closer look at what is actually going on here. Now, we have to remember, we're talking about a real estate investment trust, and when we're talking about REITs, we don't pay attention as much to things like earnings per share or free cash flow. We want to pay close attention to things like adjusted funds from operation. Ultimately, that's going to tell us how healthy the dividend payments are. So if we come down here, we can see adjusted funds from operations and the exact same metric on a per share basis. And if we look year over year, we can see this metric declined pretty significantly. Now, there's a few different reasons for this. First off, we can see on a per share basis, it declined pretty heavily because they issued a lot of outstanding shares. This is pretty common for REITs when they're looking for ways to grow. This is how they can bring on capital because remember, REITs are required by law to pay out 90% of their earnings in the form of dividends. But the other one we have to pay close attention to is look at the increase in spending when it comes to things like tenant improvements and property-related capital expenditures. In fact, it was a 65% increase in tenant improvements. Now, in the recent earnings report, the REIT stated why they did this. They want to be intentional in improving the quality of their real estate. So ultimately, what the management team is stating is they're willing to sacrifice the dividend payout over the short term to improve the quality of their portfolio over the long term. So the bullish argument for this move is that the management team is prioritizing long-term value creation over the high immediate dividend payout. So again, if you're currently a shareholder of the stock, you're probably not happy about the dividend cut. But if it's been on your watch list, some could argue this creates opportunity. We can see that starting dividend yield still sitting at about 7.42%, and if we assess the actual safety of that dividend, look at the AFFO payout ratio forward looking, sitting at about 72.87%. That's still pretty healthy for REITs. But keep in mind, if we look at the dividend history for this REIT, one of the things we will notice in the past decade, this wasn't the first dividend reduction. Starting in 2020, they reduced their dividend pretty significantly, going from 22 cents per share all the way down to about 11 cents. So this is now the second dividend reduction for this REIT in the past decade. Not a good track record. But what about the valuation? Well, if we look at this REIT from a dividend discount model perspective, what we can see is, after accounting for the recent dividend cut, if we assume a dividend growth rate of just 1%, we'd come to an intrinsic value of about $7.54 per share, which is pretty much exactly the current share price for this REIT. So here's the good news. The fact we're seeing so many insider purchases in the last few days after the dividend cut, I believe does mean that insiders are confident in the moves that the management team is making. So it'll be interesting to see how this REIT plays out over the next few years. And then finally, we have the blue chip stock Home Depot, who just saw its first insider purchase in over a year. Now, if we look at Home Depot in the past year, they are down by about 6%, but most of that sell-off comes at the end of February. At that point, they were trading at about $420 per share and is sold down to about $362 a share. So if we look at the stock year to date, again, down by about 6.24%. Now, if we look at this company from a dividend perspective, again, I'll come up here and plug in Home Depot. And what we can see is the starting dividend yield for the stock is around 2.5%. But here's what we really need to pay attention to. This stock has grown its dividend at a high rate very predictably every single year for the past decade, going from about $1.88 in 2014 all the way up to $9 in 2024. And this has been backed by growing free cash flow, 10-year free cash flow CAGR of about 9%. The past 5 years, around 8%. So this has been a great example of a solid dividend growth stock over the past decade. If we jump over to our stock screener page, we can see top lines are growing, revenue per share going from 62.16 in 2014 to in 2024, a record year of $161.13. And keep in mind, revenue on a per share basis has been growing much faster than just organic revenue because the stock has also bought back a lot of shares over the past decade. So it's more of a true shareholder yield stock. They're paying out great dividends while also buying back shares every single year. Now, one of the things we also have to make note of, return on invested capital has been very high for the past decade, above 20% every single year. This is typically a sign of a company that has a clear competitive advantage. This is a high quality stock. And if we jump over to the profitability and income statement sheet, we can see the gross profit ratio has remained stable while revenues are growing. Now, for the first time in quite some time, the outlook over the next year isn't quite as bullish as the past decade has been for Home Depot. What we can see is the company projected fiscal 2025 total sales growth to be around 2.8% and comparable sales growth of just 1%. So this is expected to be a slower year for the company, but if we look at the coming years, look at the earnings estimates, yes, slow growth over the next year, but then they're expected to get back to that 8, 9, or 10% earnings growth over the next few years. Let's jump over to my stock valuation spreadsheet and go ahead and plug in Home Depot. Thanks to ticker data, the data will load in. Let's use a discounted cash flow analysis to start, especially since this is a blue chip stock. Now, if we assume a free cash flow growth rate of about 9% moving forward for this stock, which seems pretty achievable when we look at those future earnings projections, we come to an intrinsic value of about $409.79, which is close to about 13% higher than the current share price. If we look at the historical multiple valuation, so what we're doing is looking at the price to earnings ratio over the past decade and comparing it to where it is now. What we can see on average, over the past decade, the average PE ratio was around 23 for Home Depot, and right now, sitting at about 24.28. So it's about 5 or 6% more expensive than it has been over the past decade. Now, if we look at the multiples valuation, one of the things we'll notice is if we compare Home Depot to Lowe's and apply Lowe's price to earnings multiple to Home Depot, we'd come to an intrinsic value of $283 a share. Now, this is certainly not a perfect valuation model in this sense, since we really only have one good comparable, but it's still an interesting takeaway. And then finally, if we look at the dividend discount model, assuming a dividend growth rate of 6.5% for Home Depot, we'd actually come to an intrinsic value of about $482 per share. So if we jump over to the output tab and average those three valuation models together, we'd come to an intrinsic value of about $391.82, which is about 7 or 8% higher than that current share price. But do keep in mind, the historical multiple valuation found Home Depot was a little bit more expensive than it has been over the past decade. So it looks like it's pretty close to fair value, but there may be some opportunity here. So there you go, those are 3 dividend stocks that recently saw insider purchases. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.